This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, Chief Investment Officer at PWL Capital, and Mark McGrath, Associate Portfolio Manager at PWL Capital.
What are you smiling about?
You bugged me about not saying that last time. So
yeah, I was going to ask, is that the first time you said it? Because it threw me off.
It is the first time I said it. I had to be very deliberate about making sure I got my own title right.
Yeah. Feels good?
I guess so.
Yeah. Oh, good for you. Good for you. Episode 333.
Yeah, there we go.
Yeah, it's gonna be a good one. So Ben, you and I were at a conference together on November 2nd.
Yeah.
So we got invited to the Physician Financial Independence conference for separate reasons. So you did a talk with Dr. Mark South, the Looney Doctor. Well, you did a live episode recording of Money Scope, right?
Yeah, that's right. Yeah.
How'd it go?
I think it was good. I mean, for someone who's listened to the whole series of Money Scope, it was nothing new. The intention was to do kind of like a summary of main points. Although we did structure it based on questions from the audience. So we got pre questions and we kind of used existing Money Scope content to answer all those questions. But it's a pretty good overview of the Money Scope content so far. And that, I think it is currently published as an episode on the Money Scope channel.
Oh, nice. Yeah. So for those who don't know, there's a group of, I don't know what their membership is up to, but it's north of 30,000 physicians and their family members across Canada that are part of a Facebook group. And they go by PFI, or Physician Financial Independence. And like the entire impetus for this is to kind of become better like DIY investors, DIY planners. So they're very, very big on things like index investing and, fee only planning and that type of thing. So lots of great people. A lot of my clients who are physicians are part of that group as well. And so they'll always ask me, we saw a post about this and what do you think? So it's a great group. My talk was a bit different. I was asked to do, because I've worked with physicians historically, I was asked to do the 10 most common mistakes that physicians make with their money. And as I was writing this out, it ended up being 12 mistakes. There's probably some overlap between the two, but so I did that, and I think it went really, really well. What was interesting is that I had a number of physicians reach out to me after the conference inquiring about PWL services, which was kind of surprising to me, just given the audience are largely do-it-yourselfers, and the intention of this group was to kind of take back control of their finances. And so it was just interesting to me to see some of them actually wanting to go out and get advice. And I think I kind of predicted this. I didn't say it. So in my own head, I kind of predicted this, but I was actually at MD Management when this happened, when the MD was sold to Scotiabank. And I remember just the general feeling from a lot of my clients was they weren't happy about it. Mm-hmm. And I believe that was the genesis of this PFI group. But I know my clients pretty well, and a lot of them who are leaving to kind of take things into their own hands. I thought, some people are very capable and will do a great job of that. And there was a handful of people I knew. I was like, I don't think this is the right move for you, but sure enough. And in my head, I was like, I think this pendulum at some point will probably swing back the other way. Like a lot of people are really excited about it. They're encouraged. They're going to go and try and do it themselves and probably realize at some point that they kind of bit off a bit more than they can chew, and are going to go back and seek advice through some channel. So I suspect maybe that's why people were reaching out. But yeah, it went really well, and enjoyed it and got some really great feedback. And yeah,
that's really interesting. So like, when you talk to these people who are capable DIY investors or could be capable DIY investors, what are the reasons they're giving you for why they want to talk?
Yeah, and it's interesting too, because the few that I've talked to, I've got a couple meetings still coming up, but the few that I've talked to already are like, they're doing a great job. Like all the basic fundamental things that we would usually want to look at ourselves for our clients, they're doing great. Like portfolio is fully invested in one of the one-stop ETFs, globally diversified. They've got a corporation set up in some cases. They're funding their RSPs, their TFSAs. They've got term life insurance. They've got disability insurance. They've got their wills, their powers of attorney. They've got the basics like really, really well dialed in, which is not always the case when clients are coming to us. Often it's because they don't have all of these components lined up properly. But the few that I've talked to have done a really, really good job. So I think that group has done a very good job of laying out those basics, and people are following that. And it's the same just outside of this group with people that come to us. I think a lot of people just get to a point in their career, whether it's because of family demands from the career itself, or just a lack of interest and energy to put into personal finance. They go, okay, like this is great, but you know what? I'm just going to pay somebody to outsource a lot of this thinking for me. Like there's just so many financial decisions that people make. And I always tell my clients, you're going to make thousands of financial decisions in your lifetime. And our job is to kind of be the first point of contact for all of these. And we're not going to always have the answer, but we can get you the answer and we can help you think through a lot of this, the decisions and the trade-offs. So I think a lot of people just get to a stage where, and like all of them are, not all of them, a lot of them are huge fans of the podcast, fans of your YouTube, Ben, fans of my Twitter. So they're following us and implementing a lot of the stuff we're talking about already. And I think they just get to a point where they're like, that's a lot of work. My time is just better spent somewhere else.
I get that, man. I know, like in my life, my capacity to do anything outside of, like I do my job, I spend a lot of time doing that. It's not a 40-hour a week or whatever it's supposed to be. Even when I'm not working, I'm listening to podcasts or thinking about stuff, whatever. And then I've got kids and kids activities, and then just like maintaining a house, which is a job in itself.
Yeah.
Like if someone asked me to do something outside of that, it's like, I don't have any time. Anyway, so I totally get why people that, could do this, they have the skills to do it, wouldn't want to do it because it's time consuming.
Yeah, to stay on top of things, like, and we had the big proposals for tax changes and stuff, like just to stay on top of the
it's no
external
joke.
Environment. It's like, it's a lot of work, right? And there's like new decisions come up all the time, and you can be really, really well set up, and then something changes immediately in your life or externally or in the markets or in tax legislation or whatever, and kind of throws everything out the window, and you just need another set of eyes, right? So we're basically on retainer for our clients. And so there's, obviously we've talked about this before, but there's kind of different advice models, and some people want the retainer model, and some businesses and families want retainer models for legal advice. We're kind of that model, I think, for our clients, and others just need kind of ad hoc pay as you go type services. So it really just depends, I think, on where people are at and whether they're, I think the other big thing, and I've mentioned this before as well, is the liability that comes with it. Like if you're the kind of head of a household, as your portfolio grows and as things get more complex, I find that people tend to be concerned that they're making decisions with larger dollar amounts for their families. And if they do make a mistake, it's them that's going to be responsible for it. And some people might find that to be okay, but others don't want that to interfere with their relationships with their family and don't want to have to regret that if they do make a mistake, right?
Yeah. Makes sense.
Yeah.
Interesting. Yeah. Super interesting to hear about people at a pretty DIY focused conference wanting to talk to a wealth management firm, but not surprising for the reasons you just described there.
And we covered that on a previous episode too, is why people hire advisors, and the type of people that do tend, I think you said that there's a higher proportion of, or at least the average financial literacy level of people who tend to hire advisors is usually higher than those who don't.
That's right. Yeah. Yep. People with more financially literate people are more likely to seek out advice and to seek out professional advice as opposed to whatever, a social media influencer or a family member or friend.
But you are a social media influencer, Ben.
That gets complicated, doesn't it?
Yeah.
All right. That's just interesting discussion to start. Okay. In the rest of the episode though, we are going to talk about the presidential puzzle, Trump's win and expected stock returns. And then we got a bunch of reviews and some some contrasting reviews, which is kind of fun to talk about because there were some like pretty negative, one pretty negative one, not some. And then I think like more overwhelmingly positive reviews than we've ever had in a single, whatever that is, 2-week period where we kind of collect reviews. Anyways, we'll talk about that in the after show. All right. Good to go to the episode?
Good to go.
All right, welcome to episode 333. Talking about the presidential puzzle, Trump's win, and what does it mean for expected stock returns? It's a pretty fun topic.
Yeah, so we're recording this on November 20th, and I don't know that you were going to cover this explicitly, so apologies if you were, but like we saw as soon as the election was finished, markets just went on an absolute moonshot. Yeah. And as of today, I think they're back to where we were pre-election.
Yeah. So it tends to, there's a paper that I looked at on this, that because the theory is because Republicans tend to enact favorable tax changes for corporations, there tends to be a bump in asset prices after Republicans are voted in. It's a relatively small effect though, much smaller than the effect that we're going to talk about in the episode. Okay. So Donald Trump obviously won the 2024 U.S. presidential election, and he's now set to become the 47th president of the United States. There's some other interesting stuff about him. Like, I think he's the only non-consecutive 2-term president ever. Someone might tell me I'm wrong on that, but I'm pretty sure I read that. Now, the interesting thing is that this Republican victory likely contains information about expected stock returns, but it's probably not the information that people expect to hear. Like I mentioned, Republicans being relatively business friendly. And I think people often assume that Republicans are good for the stock market, and they're not bad for the stock market. And the causality is really interesting, and we'll talk more about that. But the empirical fact, the interesting empirical fact that makes this whole discussion interesting is that the historical equity risk premium going back to 1927 has been much higher, like much higher under Democratic than Republican presidents. So that's the presidential puzzle. And there's one big paper, I think in the Journal of Finance, that identified this. And then Lubosh Pastor later had a paper that confirmed the same thing out of sample, and they put some theory to it, which is what we're gonna talk about. And I think because there's this theory behind it, and if you look at the way the world looks today, it looks a lot like kind of what this theory would predict. I think it has just interesting implications for expected stock returns. Now, the other thing I think is really interesting here is that everyone's going to have a different opinion on what the election results mean for the stock market. Like, I don't know, man. Politics are so polarized at the moment in the United States and in Canada too. But in the United States, like each side of the political spectrum in the US seems to think that the other side is like completely brain dead.
Well, it's like it's gotten to the point where it's an insult to call somebody a member of the party.
Yeah.
Like stupid Dems or stupid liberals or whatever.
Yeah.
Like, and everybody just puts you in an identity box based on your
politics.
politics.
That's right. Yeah. There's so much identity wrapped up in this stuff. And so, you know, a Democrat might think, well, Trump is going to crash the stock market, and a Republican might think that Trump's going to be super good for the stock market. Everyone's got their own opinion, but the problem with this is that everyone's got their own opinion based on their individual model of the world, based on how they see it through their own lens as a Democrat or a Republican. So this is separate from the presidential puzzle, but it's still super interesting, and it ties back. So there's this 2020 paper, Belief, Disagreement, and Portfolio Choice. And they find that households likely to be Republican, likely to be based on their geographic area and what proportion of people in that area vote Republican. They increase the equity share and market beta of their portfolios following the 2016 presidential election when Trump won. And likely Democrats, likely in the same way, they rebalance into safe assets. So Trump wins, Republicans take more equity risk, increase their equity beta, Democrats rebalance into safe assets.
Wow.
Yeah, it's fascinating. Right?
That alone is super interesting.
Yeah.
It is super interesting. How disparate the viewpoints are amongst those two groups. Right?
Yeah. And how important it is to have like an objective view of this stuff. So this is a paper by Antoinette Shore at MIT. We discussed it with her in episode 310, if people want more details on that paper. So they controlled for multiple factors to rule out non-belief-based explanations for that observation. And they concluded that behavior is driven by investors interpreting public information using different models of the world. And now it's obvious when you think about it because of like what we just talked about, like it's an insult to call somebody a Democrat if you're a Republican. It's so polarized. So it's kind of obvious that people would have such different beliefs about what like factual events mean. So Democrat households in 2016, like they believed Trump was going to crash the market. And they went to cash, or they reduced their equity exposure. Republican households believed Trump was going to send the stock market on a rocket ship, and they increased their allocation to stocks. But the problem, obviously, is that individual beliefs, like they can't all be right. Individual beliefs are not a great model for how the world actually works, and making decisions on that basis can lead to errors. So this is where the more robust model that explains the presidential puzzle, I think, gets pretty interesting. So again, the empirical fact to start is that the vast majority of the historical U.S. equity risk premium has been delivered under Democratic presidents. One important distinction that I'm going to make later, but I'll make it now as well, is that we're talking about the equity risk premium. That's the return of stocks over the return of 3-month treasury bills, not equity returns. Those things are sort of related, but they're distinct. So we're talking about the equity risk premium here. And I'll come back to that later. So this is a 2020 paper in the Journal of Political Economy by Lubosh Pastor. It goes up to 2015. I looked at data after that just to see how it fits with the model. We'll talk about that in a second. We did discuss this paper with Luboš Pastor in episode 124, if people want to go back and listen to that one. So the headline empirical result from the paper, and this is the crazy data point, is that from 1927 to 2015, the average market return in excess of 3-month treasury bills under Democratic presidents is 10.7% per year. And under Republicans, it is negative 0.2% per year.
That's so big.
So literally all of the equity risk premium over that period
that's wild.
Came under Democratic leadership.
Yeah.
Crazy, right? And I think that's surprising to people. I know it was surprising to me the first time I read that when we were preparing to talk to Luboš back then.
Well, not only that, but you see all these posts on social media and people writing articles about how it doesn't really matter who's in power when it comes to market returns. And maybe over the long run that ends up being true, but there's obviously a difference.
Well, yeah. And I'm going to say something like that later too, because like stock returns in absolute terms, as opposed to the equity risk premium, have been positive most of the time, like on average through both presidential parties. But still, this empirical fact is important. And the theoretical explanation, I think, is the really interesting part. So I'm going to get there in just a second, though. So that return difference, the difference in the equity risk premium of around 11% is obviously economically significant. It's also statistically significant. They look at that in the paper. Now, stock returns under the most recent Republican, which is Trump, and Democratic, which was Biden, presidential terms do not fit with the model. And you go and look back at all the historical presidential terms that are in the model. They're not all perfect. It's just like on average, this is what it looks like. So the equity risk premium under Trump was an annualized 14.4%, and it was 9.12% so far under Biden, ending October 2024. So no model is perfect, obviously. Like we can't use a model, even if it's a good one, to predict the future every time. And I'm going to come back to just that idea a little bit later. When I include those data, as a Bayesian would do to update their beliefs in the larger data set back to 1927, the overall results stayed directionally the same, where the average equity risk premium under Democratic presidents far exceeds that of under Republicans. So updated to October 2024, so from 1927 to October 2024, I get an equity risk premium of 10.29% annualized on average when the president is a Democrat, and 2.23% when they're a Republican. So still a massive difference, just not quite as big. The first time this was identified was in a 2003 paper. That's the Journal of Finance paper that I mentioned earlier, titled The Presidential Puzzle, Political Cycles in the Stock Market. And then Pastor in the 2020 paper finds that it persists out of sample. So in their out of sample period, it fit perfectly. Like there was a big return difference or equity risk premium difference again. Now here's the interesting part. The tempting explanation is that the different economic policies of the two parties explain the difference. Like that. I mean, that's like the polarizing political explanation is like, well, Democrats are better for the stock market.
Well, that seems obvious. Like at first glance, what else could it be, right?
Right. And it's a classic case of causation versus correlation, or correlation not being causation. So the causal relationship is the really interesting part. Now, of course, markets don't really work that way. If economic policies really had that much of an effect, the expected effect of those policies get quickly reflected into asset prices, and we wouldn't expect these big, persistent return differences. That explanation, the policy explanation, would kind of imply that investors persistently misprice stocks by failing to anticipate the expected policy effects, and then they get surprised by, wow, that was so much better than we expected. But the simpler explanation that Pastor offers in Political Cycles and Stock Returns is that Democrats tend to get elected when expected future stock returns are higher, and Republicans tend to get elected when they're lower.
Mm-hmm.
So that's the.
Does that also mean the markets generally are like lower or down or cheaper, I guess?
Yeah. So I'll talk a little bit about that. So one of the reasons that could happen, that expected returns could be higher, is that investors' risk aversion, it varies over time depending on what's happening around them. So if we take like risk aversion is probably high during an economic crisis, as one example. When risk aversion is high, investors demand more compensation for risk, which on average, over a long period of time, is going to play out as higher realized returns. Now, how this relates back to politics, and this is a really interesting part of the paper, is that when risk aversion is high, like during an economic crisis, voters are more likely to elect a Democratic president because they demand more social insurance, which Democratic leadership tends to provide. And then when risk aversion is low, like during a booming economy or a booming stock market or both, voters are more likely to elect a Republican president because they want to take more business risk.
So it does kind of tie into policy to a degree then, right? Like in that they're reacting to external events like what's going on in the economy and the markets in order to make decisions about the policies that they want to vote for.
Yes, but instead of policies causing the stock market to perform a certain way, the stock market, risk aversion causes certain policies to be favored and causes expected stock returns to vary. So the causal direction is the key to the paper here, and I think what makes it interesting. But so the result is what we see, that when Democrats get elected, risk aversion tends to be higher, which leads to higher expected stock returns under Democratic leadership. And when Republicans are elected, risk aversion is lower, leading to lower expected returns under Republicans. Now, an important thing is that in this model, Democratic presidents, they're not the ones causing high expected stock returns. I guess I'm kind of reiterating what we just talked about, but high risk aversion causes both Democratic presidents to get elected and expected stock returns to be high at around the same time. And then it's a similar story under Republicans, just in the opposite direction, I guess. They don't cause stock returns to be low under their leadership, but low risk aversion tends to result in Republican presidents getting elected and expected stock returns to be low at the same time. Now, in the paper, they go back through history and they just look at like how does this idea, they do some other interesting stuff to kind of confirm that risk aversion does tend to be high when Democrats are elected, like separate from the stock market. They look at other measures of risk aversion, but they also just look at go back through past elections and how does the model look. So they look at November 1932, amidst the Great Depression, Republican Herbert Hoover lost the election to Democrat Franklin Roosevelt. Kennedy gets elected during the 1960-61 recession. Carter gets elected after the 1973-75 recession, a Democrat. Clinton, a Democrat, after the 1990-91 recession. November 2008, of course, in the depths of the great financial crisis, Obama beats McCain. Democrat Obama beats Republican McCain. And then in 2020, everyone remembers this one more recently, Democrat Biden beats Republican Trump as the U.S. and everybody else is dealing with COVID-19. So that one wasn't in the paper, but I mean, it's a pretty obvious one to add. And then in 2024, I mean, this is where I think it's just so interesting to see how well the model maps to what we see happening. The U.S. economy looks objectively great. U.S. stock prices are nearing like all-time highs, and Republican Trump beats Democrat Harris. So I mean, I don't know. Like you couldn't make this up. It just seems so perfect relative to what they describe as their model.
Yep.
And then they look overall. They kind of look at the data of when do transitions from Republican to Democrat happen, and they find that they tend to be preceded by this. To your point earlier, Mark, they tend to be preceded by low market returns, low GDP growth, and high volatility. They also look. I mentioned this a minute ago. They look at the time series of 4 proxies for risk aversion, and they find that they indicate that risk aversion tends to start out high and then decline over the course of a Democratic presidency. And those are measures of risk aversion that are not directly related to the stock market, or they're not derived from the stock market, I guess. And another interesting thing is that change in risk aversion contributes to such a large gap between returns under Democrats and Republicans, because as risk aversion reverts to the mean after a Democrat is elected, expected returns are falling, but that's also causing stock prices to increase over that term. So fitting with this model, I mean, Trump is likely going to be inheriting a stock market with incredibly high valuations, which I would say suggest low risk aversion in the market right now. And that's again, that fits with the model. Republicans are most likely to get elected when risk aversion is at its lowest, which is often at the peak of the business cycle. And so it's not surprising, and they observed this in the paper. It's not surprising that they observe a downturn shortly after Republicans take office. That's not a surprising thing to see. So there does tend to be that little bump that I mentioned from maybe favorable tax policy expectations, but that there's often a decline after they take office. Another thing the model predicts is a larger gap in the early years of presidential terms, which is exactly what we see in the data. So in the 1927 to 2015 data series from the paper, the gap in returns is by far the largest in the early years of presidencies. So I think this model is like pretty relevant today because the U.S. economy is like, it's doing well. Stock prices in the U.S. are high, which I guess suggests risk aversion is low and that expected returns are low. Vanguard and PWL and anybody that creates expected return assumptions, everybody's expecting U.S. stock returns to be relatively low going forward because valuations are so high. The tax thing, I've got some notes on the tax thing it's worth mentioning. So that, it's basically that there is that little bump from potentially favorable tax policy, but it's dwarfed by this presidential puzzle. It's not even close in magnitude. So that's the main idea. Now, what you should actually do with this information,
short
it's
US
interesting.
Is what you're saying.
What's that?
Short U.S.
Sure.
stocks is what you're saying.
Well, so this is the thing, right? Is that if we did this episode, or if you listen to Lubosh Pastor's episode where he describes this model back in episode 124, whenever that was, I think it was around the time Trump was getting elected, because I think we talked about that. But if you had listened to the model back then and said, okay, well, I'm gonna do that, I'm gonna act on that information. Trump, as we mentioned, the returns under Trump, his first term were incredible, and they've been great under Biden too, but not as great. So it's like you have to have a lot of confidence in a model, which you probably shouldn't have, but you have to have a lot of confidence in it to make asset allocation decisions based on that model. I think there's just too many other variables, other factors that can affect actual outcomes. So over the next, 100 years, there's a good chance I think that this model is predictive, but over any individual presidency, I think it's tough. Yeah. And then the other thing that I mentioned earlier is that this is looking at the equity risk premium. So that's the premium for owning stocks over short-term government bills, in this case, 3-month treasury bills. But raw stock returns, if you just look at have stock returns been positive, they've been reliably positive on average under both Democratic and Republican leadership. So we're not talking about you're not going to lose money necessarily. We might have a market crash. I don't know. But we're not saying that on average you should expect to lose money by staying invested when Republicans are in power. It's just that the risk of owning stocks has been better compensated while a Democratic president leads the country. But stock returns have been reliably positive no matter what.
So don't short U.S. stocks is what you're saying.
I don't think so. I don't think you can use this to time the market.
Yeah.
I don't think so. That most recent out of sample period that I did the data for, it kind of proves that point, right? If we had this paper and we said, okay, we've got this model with data to 2015, let's implement this strategy. You got wrecked.
Yep.
As often happens with back-tested strategies. So I think that's an issue. Even a good model that has been historically successful at explaining differences in returns, it's not a perfect guide for future decision making, especially for something like this. I love the test for a strategy of what happens if I'm wrong, right? With the dimensional funds that we use, they own the total market. They're slightly tilted towards small cap and value stocks and high profitability stocks relative to the market, but they still are based on market capitalization weights, just with some adjustments. So what if I'm wrong? What if there are no return premiums? Well, it's not really that bad. But if you short U.S. stocks and you're wrong, you get destroyed. Or if you exit the U.S. market, we could have had the same conversation 5 years ago or something. Valuations are super high, blah, blah, blah. And then the U.S. market's just like a rocket. So I think it's really hard to do anything with this information. However, I think in the other direction, it's worth being careful in light of this model. Again, this is just a model. It's not perfectly predictive. You shouldn't probably make major asset allocation changes on it based on it. But believing that the incredible recent U.S. stock returns are going to persist forever at a time when valuations are high and risk aversion is low. And this model about, presidential elections suggests that, hey, maybe expected stock returns are low right now. I don't know if I'd be going all in on U.S. stocks just as much as I don't think I'd be shorting them. So I think that's another important thing to think about. Diversification is always important. It's like an umbrella, and you don't want to have to buy an umbrella after it starts raining.
Yep.
So if we step back and look kind of objectively at the empirical data, there is this puzzle. The puzzle's there. The equity risk premium has been much higher under Democratic presidents than Republican presidents, likely due, based on the Pastor paper, to time-varying risk aversion, causing expected stock returns to be high when Democrats are elected and then low when Republicans are elected. While that may make market timing tempting, no model's perfect. And the reality is that while the equity risk premium has varied, average stock returns have been reliably positive through political cycles. There's a great chart that we have that Dimensional Fund Advisors made. They posted on their website, so we can show that in the video. But it just shows, like, over time, markets have just kind of gone up, and they've gone up whether it was a Democrat or a Republican in power. Yes, there was more equity risk premium under one party than the other, but like, you can't time that, and expected returns are positive no matter what. So, I mean, whatever. You got to stay invested, stay diversified. Politics can get super emotional, as we've seen pretty clearly, just everywhere. But and in that 2020 paper by Antoinette Shore, that shows it in such an interesting way. But you can't let your individual beliefs cloud your judgment. One point actually on the Antoinette Shore paper is that they do find that, and they look at this empirically, the best ways to reduce the impact of individual beliefs on investment decisions. One of them is the best way is to delegate your portfolio management. And that can be done either with an automated investment product, like an asset allocation fund, or through a professional financial advisor. So they find in the paper that both of those things reduce this belief-based action on portfolios. All right, that's it.
Super. So I've lived, I'm sure you guys have too, and everybody who's an advisor listening to this has probably been through these exact conversations with clients. But I had this exact problem with a client in 2016 when Trump was elected. So these clients, they were the physician household. They had about, I think it was just shy of like $5 million invested. So it was quite a bit, but they were 90% fixed income. So very, very, very conservative investors. They were probably in their late 50s, I think maybe early 60s. So gearing up for retirement. So maybe risk aversion was higher for them personally at that time as well. But they were always very, very conservative, like lots of GICs, tons of fixed income. So they had about 10% total exposure to global equity, and only about somewhere around 4% in US stocks, 4% of their portfolio in US stocks. And she called me, like, it was something like 2 days before the 2016 election, full on panic, sell everything, Trump's going to win. I'm like, okay, well, hang on, like, let's back up here. Like, sure, he might win, but like, so what? She was convinced that not only was he going to win, but as a result, the market was going to absolutely crater, right? And it was a really difficult conversation because on the one hand, you're trying to explain you don't really have that much exposure. Like, you don't have, it's 4% of your portfolio. If it went to zero, you're talking about a 4% loss. Everything is in super safe investments, GICs and fixed income. But to your point, like, what if you're wrong? Like, you can predict the event properly and be correct on like some binary outcome, but not predict how the market's going to react to that event properly. Yeah. And that's, of course, exactly what happens. Like, I pleaded with her and I just couldn't win that discussion with her. And I said, you know what, if it's a sleep at night decision and you're more comfortable, and knowing, of course, that it was not, the opportunity cost of her being wrong wasn't that high just because their exposure to stocks in general was relatively low. It's like, fine, let's do it. So we sold the whole 10% equity sleeve of her portfolio and went to fixed income with it. And of course, she was right. Trump won. And the market just went on an absolute tear, right? I think I looked it up yesterday, and from the time she made that decision to the time I left that role, so I ended up leaving that role and handing that client off to another advisor. And at that time, she had still not got back into stocks. And this was in like January of 2018. So you're talking 13 months, 14 months between the time she sold and between the time I left. So I don't know what the eventual outcome was, but at least over that 13-month period, she hadn't gotten back into stocks in general, and specifically not US stocks. I looked it up yesterday, and the S&P 500 was up like north of 30% over that time frame. So opportunity cost was massive. And going for the full 4 years of that particular term, 2016 to 2020, the S&P 500 in US terms, in US dollar terms, was up 80%. So assuming she never got back in, that was the cost of making that sort of irrational decision. And again, their exposure was relatively low, so the upside wasn't huge in dollar terms, but it just goes to show that making emotional decisions around, predictions about what markets might do because of some event is a very dangerous way to manage your money.
Oh man, we had not so much this time, which is interesting. I don't know why that is, but in 2016, Trump was like, people couldn't even believe that he'd gone in like to run for president, and he did it, and he won, and everyone's like kind of mind blowing. Maybe this time because he's already been there, but this time is even crazier though. Anyway, well, we didn't get many calls about it this time, but back then we got a lot of calls from people with the exact same sentiment, like this is crazy, the market's going to crash, and of course, like you mentioned, it didn't. I think the other really important point in your story though is that market timing, you don't just have to be right once.
Yeah.
Because even if it had crashed, right? Even if the market had crashed, you have to be right twice.
Yep.
You have to get out at the right time, and you have to get back in at the right time. And getting back in, I mean, I've heard stories. I don't have clients that are in this situation, but I've heard stories secondhand from other advisors of clients who got out of the market in like the 2000 tech crash and still to this day have not gotten back in.
That's just it. And if they were right and it does crash, it's still really, really difficult to get back in because you're at the hard ride edge of this drawdown in the market. You're like, no, it's going lower. So
and people never want to get in after the crash.
And when it
like
bounces
they wait
back
until
up,
it recovers.
like, no, this is a dead cat bounce. It's going to drop again, right? And then it just keeps going up. And then now what? Like you're handcuffed. You don't know. You're paralyzed. Yeah. When do you get back in? So even if you got it right on the sell, like you said, you have to be right twice. And whether you're right or wrong the first time, it becomes very, very difficult to get back in, whether the market does go down and you were right or whether it goes up. It becomes emotionally and psychologically very difficult to time it back in.
Yeah. Yeah. So I definitely don't want people to interpret the differences in expected returns under different types of political parties in the United States as a suggestion that market timing makes sense. I think we're pretty clear about that. But I think it's just a really interesting point. And probably my biggest practical takeaway from it is like continuing to expect that the recent U.S. market performance is going to be like, that's just it. That's the future. Like, I think that's a big mistake. And again, I'm not saying that you should not own U.S. stocks or that you should short U.S. stocks because those have, I would argue, greater risks. But I think the most reasonable way to use that information is in setting your expected return assumptions. Don't assume the U.S. is going to keep returning 10% a year nominal forever, or it's even higher in recent history. Yeah, so I think we'll see. I've said similar stuff, at various points in the last 10 years, and the U.S. market has kept going up. So
you've been wrong before, Ben? Is that what you're saying?
I've been wrong so many times on that one. Anyway, yeah.
Yeah, no,
all right. So that's,
I think you're not doing anything with your portfolio with this information, are you?
No, not at all. I mean, I don't see how you reasonably could.
Yeah.
It's just there's too much uncertainty. And I mean, that the example of 2016 is such a good one, where if you got out of the market, even with the Pastor model of like, hey, expected returns are probably low right now. If you got out of the US market, then like you got absolutely wrecked.
Yeah.
Even if you got back in under Biden, I mean, you still got some positive returns at least, but you missed out on a huge chunk of the equity risk premium over that period.
Yeah.
So,
well, if it was a perfect model, then there'd be no difference, right? Like it'd be arbitrage anyway. So it can't be a perfect, predictable
true.
model.
If it was a perfect model, it would just be reality, and reality would adapt to itself. I don't know.
Yeah. Yeah. Really interesting.
Yeah.
You should do the same thing with Canada at some point.
What's that?
I said you should do the same thing with Canadian data if you can at some point. Like obviously
you know
the US,
what?
The big market.
I had it in my notes. I don't know. I guess I must have taken it out at some point. But I did have it in my notes that they test this. Where did that go? Hold on. I must have deleted to trim it down or something. I'll see if I can find it real quick. But the thing is, they do look at it for other countries, but not for other countries' political parties. They used U.S. political parties as a proxy for global risk aversion. And they just argued that the U.S. is such a big player economically around the world that it's probably reasonable to assume that there's a relationship between global risk aversion and U.S. presidencies. And so they test that, and they do find in Canada was in there, and I want to say Australia, Germany, maybe the UK. I'll keep seeing if I can find it here. But they do find that there is the same relationship for all of those countries, for all of the other countries that they look at.
Interesting. So people in foreign countries, their risk aversion is, the returns. All eyes are on the U.S. basically.
Yeah,
for
that's
foreign investors.
Kind of what they're saying.
Yeah, that is really interesting.
I guess I took that out of my script, which I'm kind of regretting now because it was a really interesting point.
Yeah.
But yeah, so they do test it in other countries just for robustness of their model, and they find the same effect as there, which is I think pretty interesting.
Yeah, it would still be interesting to see it with Canadian politics, but I wonder if Canadian politics largely follow U.S. politics, like if we were more right or left wing leaders at the same time as
I have no intelligent comments on that.
Yeah, no,
I don't know.
I'd
be interested too, for sure.
Yeah.
Cool. All right, should we go to the after show?
Indeed, let's go.
Can you ask me if I've watched any interesting content recently?
Have you watched any interesting content recently, Ben?
Nope.
Okay. Glad I asked.
Someone left a comment. I don't know where it was, or if it was an email or something, but someone left a comment saying that they absolutely love it when Cameron asks me if I've watched any recently, and I say no.
Yeah. Well, I mean, you mentioned it earlier, right? Like it's the same as me. I read, but I don't have time for. Although my kids have been sick, my wife's been sick, so we've been watching movies and stuff and having movie nights, and as my son calls them, super nights.
Yeah.
Which are lazy nights and late nights. So lazy nights are like movie nights, or you order pizza or whatever. Okay. Late nights is when he gets to stay up past his bedtime. So we started doing like one day a week. And when we do both, it's called a super night. So we've caught up on some shows and stuff, but it's all kids stuff, right? It's Disney, and he's big into spooky movies like Halloween. When I was a kid, I loved scary movies and spooky stuff, and Halloween's like my favorite. And I don't somehow genetically like downloaded that to him. He's just obsessed with like scaring himself. So we caught up on a bunch of like, family movies with Halloween themes and that kind of stuff.
That's super funny.
Yeah.
We did our first episode with me not being there.
That was the first one, eh?
First ever,
yeah. Yeah, it was really, I loved it. It was great, actually. Just me and Cameron. Just two guys, having some fun. The imposter syndrome was a lot lower. I wasn't worried about sounding like an idiot in front of Ben Felix. It was pretty nice.
Oh, man. So funny. All right, so I mentioned in the introduction that we got a bunch of recent reviews, so let's rip through those. I'm actually going to start with someone reduced their review from a 5-star to a 2-star, and they said lately not as great, not as captivating. Maybe it's because there haven't been any Benjamin and Cameron only podcasts lately. If it ain't broke, ... Now, the reason I'm interested in just the dispersion of reviews here is that there was that one that was pretty negative, and they say they don't like the recent content. And then we got how many more? 1, 2, 3, 4, 5, 6 other ones that were like overwhelmingly positive about the recent content.
Well, I think like people tune in for different reasons, right? And we've talked about this too. I mean, we do stuff like we did today where it's kind of you've done a deep dive on a particular topic, and it's largely you kind of coming back and telling the audience what you found. We do some Canadian specific financial planning stuff. Then there's obviously the guest episodes are huge, and the types of guests we have on are super varied as well. So I think the podcast does a lot and covers a lot of different themes, and I'm sure listeners like some things and maybe not others, but then there's others who like the other thing and maybe not, so it's hard. I think it's just hard to please everybody. And if you were listening because you liked this one thing and now we're doing that less, then you're obviously not going to be as happy. But like to your point, we'll read these out, but we got a ton of great comments on like the RESP episode, the education funds episode we did with Dan as well. Like people loved that one. And that was a really specific Canadian financial planning topic. But maybe some people who are, foreign listeners or really here for your deep dives, Ben, they were kind of like, man, that's not my stuff. Right.
I don't know, man. Dan's like soapbox at the end too about like commentary about how the RESP may not be accomplishing its goals.
Yeah.
I wondered like, is that relevant
We're
to
getting
people who are trying to make individual financial decisions? And there were so many reviews that were like, I love Dan's soapbox.
Yeah.
Like, man.
Yeah, it was great. I mean, I think as long as you keep pulling off that hairstyle, we're not going to lose any listeners. So I'm not too worried about the negative reviews, you know?
I told you before we started recording that you look like an AI avatar of yourself because your beard is so perfect.
Well, I have to keep up. Like every comment on your YouTube channel is just like, oh, Ben Felix, he's so dreamy and everything. And I'm like, hey guys, you know, like I'm here.
Oh man. Should we rip through these reviews?
Sure.
Okay. So this is Ed from Canada. Keep the Canadian content coming. Been listening for a few years and thoroughly enjoying it. Some of Ben's technical dives go over my head, but the common respectful tone keeps me listening. Just listened to episode 329 about RESPs, which is very relevant to me. Wish I'd known those details earlier. Given the variety of topics, to your point, Mark, it seems reasonable to focus on Canadian topics occasionally. I agree.
Another nod to the RESP episode. This is from Glenn in Ottawa. So on your recent RESP episode, I really appreciated Dan's candid insights about how RESPs are not meeting the goals they were intended for. So as you mentioned, Ben, his little soapbox segment at the end was very well reviewed. Glenn goes on to say, helping lower income families fund higher education and his suggestions for improvements. I hope people with influence in government are taking note. Thanks, Glenn.
Yep. Daniel R. Oh man.
Daniel R.A. McKenzie.
Ramkenzie? R.A. McKenzie? Anyway, they say, great pod. Love the pod. Sometimes it's more technical and detailed than I can handle, but that may be more of a reflection on me than the guys. All right.
So that's what I mean. Like there's a lot of people I think who are like really quantitative focused, Ben, who love like your super deep dives and some of the highly intelligent guests we get. And then there's some people like even me, I always like your stuff goes way over my head most of the time too. So anybody listening who feels bad that they don't get some of Ben's stuff, don't worry. Like I don't get it either.
Can I tell you a secret, Mark? It goes over my head too.
Okay. That makes me feel a lot better. Okay. So the next one is from Fish, maybe. I learned a ton from the Rational Reminder. The co-hosts are incredibly knowledgeable and bring in equally knowledgeable guests with a range of perspectives. I especially enjoyed the recent episode on education savings and Dan's policy analysis of the RESP and its limitations in improving savings of low-income households. More of these critical policy analyses, please.
So funny, man.
Yeah.
I don't know. Doing a podcast has taught me so many times that I have no idea what is like a good thing to do on a podcast. So many times me and Cameron and you now, obviously, since you joined us, Mark, we talk about like, should we try this? Like, oh, I don't know if that's going to be a good idea. And like 90% of the time, everyone's like, oh, I love that.
Yeah. Well, and it's the same with like posting on social media too. Like usually my throwaway tweets that I'm thinking of like as I'm falling asleep, I'm like, oh, I should post that.
Oh, yeah.
Some weird time of night or whatever. And you wake up and you're like, oh, that's one of my best performing tweets. And I put zero thought into it. But then you craft a thread over 2 days and do a bunch of research and crickets, right? So you never really know.
That's the worst.
You just got to throw it out there and let people tell you what they like, right?
That happens to me all the time, man. Low effort tweets that just blow up, and then I'll spend like, you know, I'll take a video script that I've spent like 3 weeks writing, and then I'll condense it down into a tweet thread, and then I'll post it, and it's like crickets.
Yeah.
This is from JLS3249 in Canada. They say, great team, wonderful seeing the team grow. A shout out to Mark, great sense of humor. Very interesting perspective on topics with great examples coming from his experience with clients and his interactions on social media. He spices things up and always happy when he's present on the show. That's a pretty good call. You just said that no one says anything nice about you.
Well, it's funny because you're always like behind the scenes, you'll always post reviews and comments that you get on like on the YouTube and everything. You post them in our Teams chat. Yeah. And usually you post the negative stuff. And so like I have this like I was joking with Ben the other day. I'm like, oh, okay, I quit. I'm like gonna go dust off the resume and apply at Starbucks. Like nobody likes me, kind of thing. So I think I'm glad that you put this in. Thank you. And I'm sure you did it just to appease my sense of defeat because everything's all about, you know, Dan's a great addition. I'm like, hey, what about me, guys? You know, like I'm still here. I'm largely joking. I appreciate you throwing in that.
I posted one that was like pretty savage. I don't remember what it was. But it's the one that you're talking about.
Oh yeah, I don't know. I don't remember what it was. I tuned it out. I blocked that part of my life. You posted
it's probably wise. I won't try and find it.
No, but thank you to JLS3249. I appreciate you.
Oh, I didn't finish reading it. Now that Dan is present, there is Just one member missing to complete the dream team. When will Justin Bender finally step in for a segment? They will have Justin on for sure.
Mm-hmm.
Justin's super busy crushing portfolio management, financial planning, but yeah, we'll have him on for sure at some point.
Nice. Okay, and then another one for the RESP episode. Thank you for the terrific insight into how withdrawals for an RESP could work. Investing and saving has been the easy part, mostly thanks to Dan's terrific Couch Potato blog and tools early in my investment journey. Looking forward to working with PWL in the future, as my retirement withdrawal strategy will need a plan. As always, an excellent podcast, forever increasing and validating my investment knowledge. From SNK Squirrel on Apple Podcasts.
Very nice.
Very nice indeed.
I don't know if I have anything else. I did go to Boston. I don't know if I think we said that. Did you guys maybe say that?
Well, we recorded while you were in Boston, so we mentioned that you'd been, and I think we mentioned just at a high level why you were there. But yeah, what was that about?
Okay, yeah. It was a great trip. It was one of my teammates, Matt Janning, that I played with at Northeastern, was inducted into the Northeastern Hall of Fame.
Very cool. So
he's a good buddy of mine, and I figured I'd go support him. And a few of the other guys that we played with were there too. So it was really nice to see some of those guys, see the coaching staff. We caught a game. They lost to Princeton by 2, but it was a good game. It's too bad they lost, obviously.
Did you get to play at all? Like just pick up ball or something while you were there?
No. During the season, that'd be tough. I think if I went in the summer, they do a lot of pickup just to stay in shape, but they're not. Yeah. I don't think they're allowed to practice in the NCAA in the summer with a coach in the gym. Yeah. If I went in the summer, I could try. I'd probably just get wrecked though at this point. I don't know.
Yeah, you're out of practice.
No, I still play a lot. I almost had a huge dunk in my Sunday league last week, but someone hit my arm and I lost the ball. Still went in the basket, but I didn't get to do my huge dunk.
Do you dunk on people though? Like otherwise, like it didn't happen this time, but like do you like dunk on people and like yell in their face and stuff?
The last few years, I've been good for like maybe one dunk a season. So I'm not.
Nice.
I wouldn't say that I dunk on people.
Yeah.
I can dunk.
But it's not like the NBA where you're seeing like people like aggressively dunk on people.
No.
You're up there screaming in their face like a caged animal or something.
No,
okay.
I mean I'm playing in like a men's league for all the guys are, I don't know, 30s and 40s. Not a whole lot of dunking going on there.
Yeah. No, fair enough.
Yeah. Anyway, I think that's it. Anything else?
No. There's a Bitcoin meetup in my small town of Squamish next week. I might try to go.
You know, I've been invited many times to the Ottawa Bitcoin meetup. I'll probably go at some point.
Yeah.
I'm be interested to see the folks that go out to those.
Yeah. Obviously, I think it's one of the first ones in Squamish where I live. But I've been just reading more books about that kind of stuff lately, and I post about it on Twitter from time to time, and have been wrong mostly about stuff. And so one of the speakers reached out and she's like, "Oh, you should come and like we're doing a meetup in Squamish. You should come and check it out." I was like, "Yeah, you know what? Like, I should do that." So
yeah, no, that'd be fun. Yeah, I'll do the Ottawa one at some point.
Mm-hmm.
Yeah, Bitcoin's so interesting, man. So interesting. One of the things I've been thinking about with Trump and Musk and all that stuff that's happening, is it like Bitcoin's based on a certain political and economic ideology.
Yep.
Like that's ingrained in everything right down to the technology.
Mm-hmm.
And that those ideologies aren't things that like necessarily naturally emerge. But you can have someone come into power like Trump and Musk who can like will that world into place.
Totally. And the knock-on effects can be significant, right? Like if now other countries need to follow suit because they're concerned about falling behind in that particular arena, then they have to step up too, right? Like I think since then somebody in Poland, one of the politicians in Poland started talking about a strategic Bitcoin reserve. And so it'll be interesting to see the kind of spread of his Bitcoin policy around as well.
Yeah, it will be interesting. It's also going to be interesting to see what happens with MicroStrategy.
Yeah. Have you listened to Saylor talk about Bitcoin?
Yeah, he's different.
He's different for sure. He's obviously highly intelligent. He graduated from, I think, MIT, I want to say. I don't follow him closely, but I checked out a couple of his videos.
I don't doubt that he's brilliant, but he's very different perspectives.
Well, and that's just it. Like you have, to your point, you kind of need a certain worldview to make sense of that whole technology, and like just your view on economics has to be different from the kind of standard Keynesian view of economics. And if you do subscribe to that view, then everything makes sense. But if you don't, then what, right?
But that view can come into and out of favor.
Yeah.
You know what I mean? Like if the US starts going through like massive deregulation and whatever other stuff they're planning on doing, that could favor crypto.
Yeah. And does it become safer as a result? Like if now we've got, countries building strategic reserves, like is this a backstop for it or a floor for it? No, I don't know.
I don't know, man. Like regulations exist for a reason.
Yeah.
Regulations are written in blood.
Right. And if it's safer, then should you? No, I don't know.
We might have to learn. That's that old joke about crypto that it's speed running, whatever number of years of economics and finance, like relearning all the lessons that have already been learned. Anyway, I don't know. I don't know if people find us just chatting about crypto interesting or not, but
I think they probably do, right? Like, I talk to people about it just like in public and on social media and stuff. And so I think people are interested. Not that I've got like the people I talk to are more educated on the topic usually than I am. But it's interesting because like I used to dunk on it quite a bit. And then people are like, well, have you done your research kind of thing? Have you done your mandatory 100 hours? Like you're not allowed to talk about Bitcoin negatively unless you've done your 100 hours of research because that's how long it takes to understand it. Like, no, I don't really think I have. So I went and read up a bunch of books on it. And it's like, there's some pretty compelling arguments there. And I'm just not like smart enough to know if it's a good decision or not. Like I own a little bit just because as a hedge against my own ignorance kind of thing. Yeah, I think people would be interested in our views on it. I mean, you guys did like a 17-part crypto series that was largely around other, like crypto in general, not specific to Bitcoin. There was a lot of Bitcoin stuff in there, but Bitcoin seems to be its own thing.
Yeah, I think so. I think from I don't know. The politics of Bitcoin are very specific. I'll say that.
Yeah. Cool. Anything else?
Nope. I think that's good. As always, let us know what you think of the episode. Leave us some more reviews if you hate the show now, or if you love it. Let us know.
Only good reviews. Only good reviews, please. Thank you.
All
if
the
you don't like the show,
reviews.
you can email us. Yes.
You can tell us you hate the show, but leave a 5-star review so that other people can find it.
Thank you.
Because they might not hate it as much.
Exactly.
I don't think we have very many people that listen that hate the show, especially at this point in the episode.
Yeah, there's some.
If you're still listening right now and you hate this show, you got to reconsider your life.
Yeah, that's on you, not on us.
All right, we're just being idiots now. Let's shut her down.
All right, see you next time.